Hi, I'm Neil Katz for the Weather Channel, and this is the Climate Corner Office. Today I'm speaking with Brian Deese. He's the former acting director of the Office of Management and Budget to President Obama, a senior fellow at the Harvard Kennedy School, and now global head of sustainable investing at BlackRock, a global investment advisory firm with 7 trillion, that's trillion with a T, assets under management. That's quite a resume. Your LinkedIn's fantastic. Thank you for joining me.
I'm happy to be here.
Start from the ABCs. Some of our audience are in finance, a lot are not. What is sustainable investing? How is it done? And maybe as importantly, what makes a company investable in terms of what they're doing for the environment?
Simple definition of sustainable investing. You combine the best of a traditional investing approach with insights or data about a sustainability issue, be that environmental stewardship, climate change, in order to create a better long-term outcome for your client. That sounds simple. It gets complicated quickly. But what it entails typically is looking at traditional ways of investing and asking the question of, are we missing something that we could benefit from by looking deeper at data, for example, on how climate change is affecting markets, how climate change is affecting companies. Mm-hmm. The question comes down to where and in what circumstances do we have conviction that a traditionally things that are thought of as non-financial, like climate change, mm-hmm. or like the diversity of your workforce. Where do we have conviction that those are indicators of that a company will perform better in the future? Mm-hmm. And where we do, how can we integrate those into an investment strategy to generate a better outcome?
So give me the pitch. I've got $1 billion. I want my money to make money in your hands. And you give me a pitch about climate change, and I'm thinking, I can do charity work on my own time. I came to you to help me make money. What is the pitch and how does it work?
Well, look, you put your finger on the first thing in a lot of those conversations, which is there is a dominant negative presumption that the idea that if you start to integrate sustainability considerations into your investment decisions, you're engaged in an exercise to lose money. Right. And that has been a pervasive view for years and decades in this space, that socially responsible investing somehow required a trade-off, mm-hmm. Required this financial trade-off to trade value for your values. And so where I start is to say we have come a long distance, and the data and the technology have put us in a position where that trade-off is a thing of the past. And you don't necessarily have to make that trade-off. And you can think about that in very common sense ways, right? If you had 2 companies that have equal financial attributes, one of which is operating in incredibly climate-exposed regions along the coast of the United States, and another which isn't, mm-hmm. which company is more attractive to you over time? If you have one company that is actually effectively managing its workforce so its employees are happier, they feel more accepted in the workplace, and another company that is creating an environment that is hostile, we've seen what happened: companies losing billions of dollars of value because they lose a social license to operate. They mm-hmm. lose their employees in the process. And so connecting the broader academic research that we do to common sense company examples, I think, is a way to try to bring people along that this is not a fool's errand, that inevitable trade-off between value and values is something that we can move beyond. And then the question becomes understanding what are our clients' needs, what are our clients' interests, and how can we build a portfolio that will suit those across time.
So give me a sense of who's out there and what the opportunities are. Are there particular industries that you think are under threat, that have risks that aren't well priced? And are there industries you think have opportunities that are not yet fully priced in, that may actually do better in a climate change enhanced world?
So this is where it gets really exciting. When you think about the macro trend, which it really is a global macro trend of the transition to a low carbon economy, it's going to affect, people traditionally think about that as affecting energy production. So think about, natural gas and coal versus windmills and solar panels. And of course, that's a key element. But globally, that transition to a low carbon economy is playing out across every way in which we operate in life. It's not just about the electricity we consume, but it's about the transportation that we take to and from our jobs. It's about the way that we operate in our home, and the ability to control everything that you own and operate from your smartphone creates extraordinary opportunities to reduce the resource consumption of your basic behavior. It's about what we eat, right? And increasingly we're seeing a consumer-oriented move toward being more sustainable in the way that you eat. And as a result, what that means is risk and opportunity in companies that extend far beyond sort of traditional oil and gas versus renewables to say, in almost every industry segment, you can ask the question, are particular companies more transition ready than others?
So let me talk about a class of companies that your firm has taken some criticism on having heavy investments in on behalf of your clients. So in the fossil fuel industries, on behalf of your clients, the firm has invested one of the top three holding positions in almost every major fossil fuel company in the world. I think you're one of the largest holders of coal, if not the largest. And people wonder about the maybe responsibility the firm has, because you have such an ability to move markets and move behavior in a way that me composting in my backyard does not. How does the company see that balance?
Sure. So because the vast majority of our equity holdings are in index funds, we end up being one of the top owners of every industry. So we're also the top owner of renewables companies. We're also the top owner of wind companies.
How about composting? How's my investment doing?
A number of those companies are emerging and not quite operating in the public markets.
Great.
But
that's why I need to talk to you. I was making the wrong moves. So.
But then the question goes to, well, how do we operate, and what's the role that we can play in the overall context that we own the market?
What's
companies
your ESG score? Right?
across the spectrum, and I think that to me the answer is twofold. One is we can provide more choices and more options so that clients who are interested in investing, for example, while divesting from coal companies, have the ability to do that, and have the ability to do that with the same ease and the same cost of traditional investment. But also the ability to say, this is not just about excluding entire industries or entire classes of companies, but it's also about trying to understand, again, which of these companies is better positioned for the transition. And a lot of the work that we do is actually, we hold ourselves to an industry neutrality perspective, meaning we don't look and say, do you want to get out of traditional fossil altogether? But within traditional oil and gas companies, which of those companies are doing more to position themselves for the low carbon transition and which are doing less?
Yeah.
Because we find some clients are just interested in shifting their money away from those industries altogether, but other clients are actually interested in trying to understand and encourage companies that are making that transition. And so part of what we can do and part of what we need to do more of is to offer those choices and offer them in a way that our clients understand the opportunities.
Right. Our clients essentially worried that those industries forget about the morality, are in a very risky position, in particular with stranded assets, and they may have billions of dollars of value buried in the ground that environmental regulations never allow them to bring up and burn and turn into production. It would seem to me that as an industry, fossil has some real risk that maybe is endemic to the sector. And what are they doing, and who are the players that have innovative ideas about how to deal with that?
Traditionally, the dominant view has actually been a concern that actually tilting away from those companies would force you to sacrifice return in the short term. And I think that has been, in some cases, connected to an insufficient recognition of these risks that companies that are operating in a macro environment where we are transitioning to a lower carbon economy may face risks, and those risks of stranded assets or of diminution value may happen more quickly. Under different scenarios, they could happen very quickly. And investors need to understand that and appreciate those risks. Part of that is an education effort, but part of that goes to your question around how are companies positioning themselves for that? And you see some, in the traditional oil and gas company, you see some companies that are making very aggressive moves now to reorient their business model, to reorient their focus and their priority. And so we look at things like the CapEx and R&D budget of these companies to say how much of their forward CapEx, where they're, the investment they're making today, which reflects where they're going to be 5 or 10 years from now, how much of that is green. And how much of that signals a kind of an investment in a future state that could look different from the present.
Do you think the next stage for these companies is to remain in energy, but just try to buy or innovate their way into green energy, or do they just become something else, real estate holding companies or logistics firms? They have a lot of core capabilities that they've built over decades to affect our global economy. What's the future for that sector?
So I think it depends a lot on, we got to be specific about what company types we're talking about. So,
Sure.
If you're looking at kind of pure play coal companies where that's the dominant source of their operation, in most cases, that's going to result in a wind down. If we look out over any reasonable horizon, certainly in the United States, we're seeing the market, even in the absence of, or even with a lot of uncertainty, regulatory uncertainty, the market is driving those business models out of existence.
Right.
If you look at utilities, we see a real skew. Some companies that are really changing the nature of their business model and becoming, there's a big question about whether it's the right question is what's the future of the utilities or what's the utility of the future?
Right.
And the utility of the future may look very different in an environment where, most of the incumbent source of power is coming from wind and solar, intermittent sources, where the grid looks different because storage enables different structures and different regulatory structures as well. And so there are some companies that are really thinking ahead and being proactive about jumping ahead of that and creating and inventing new business models that would actually create huge opportunity, for example, to leverage a technology like storage to create positive disruption in the way the traditional utility business model has worked. With respect to oil and gas, I think it's a question of transition and it's a transition of fuel sources. And also transition of business models as well. And I think we're going to see disruption. We're going to see players trying to understand when and under what circumstances to make those transitions. And part of our role is to provide the clearest possible picture that we can of those risks, so that clients and investors can make decisions about, how confident are they about the speed of those transitions and the capability of these companies to pivot.
Tell me about carbon beta. Explain what it is and how it works and how a company might use it, or how an investor might use it.
When you're thinking about this question of transition readiness that we're talking about, transition readiness of a company, you want to ask yourself, what are the drivers of that transition? One of them is technology, right? And we're seeing low carbon technologies driving changes, driving disruption. But another big element of this is regulation, right? And so the world's actions, individual governments' actions, states' actions to put a price on carbon or to take other regulatory action that implicitly raises the price of carbon is a big factor in the speed of that transition. So one of the things you want to know is what is the impact on a company of an increase in the price of carbon. So carbon beta is a very simple concept, which says, look at a company and understand the sensitivity of that company's profitability to the price of carbon. Mm-hmm. And we build that in a bottoms-up way, looking at the business model and looking at the capability of the business model to pivot away if high carbon activity gets a lot more expensive than low carbon activity. Put that all together and create a tool that allows us to say, okay, for an individual company and then for an entire portfolio, what happens if the price of carbon globally goes from where it is today and it doubles?
Right.
That allows us to do stress testing, the types of things that you would do to a portfolio for what would be considered a traditional financial risk. What happens if interest rates change? What happens if there's a terrorist attack or a recession? This allows you to say, well, what happens if there's a regulatory shock that would have a significant impact, and what does it mean for my portfolio? And for an investor, it's a powerful tool because being able to understand that at the individual company level, but then aggregate that up to the portfolio, allows an investor to know what they're holding, know what kind of risk they're holding, and maybe take action to position themselves against that risk. And obviously, you have to make a judgment about when you think that regulation is coming, in what geography, and what the probability of that is. But that's like any other traditional investment approach. Getting better at understanding what risk you hold makes you better at pricing that risk in, and then delivering an outcome where you've mitigated that risk.
So in reading your report on carbon beta, one of the things that surprised me was how sensitive many industries are to a price of carbon that didn't even seem that big. So when people talk about the regulatory price of carbon, 25 to 80, some people think it's around $40. But you guys were modeling at the bottom of that, and it looked like the materials industries, I think construction, healthcare surprised me. These were industries that were underwater if the price of carbon goes even to the low end of what some people think the regulations will be. How do you guys think about that?
Well, so it was surprising to us as well, but also instructive. This is why we do these types of modeling, to help us understand what the actual impact would be. Traditionally, the social cost of carbon has been about $40 a ton. That's sort of understanding the science, what the actual what the appropriate price would be if you priced in those externalities. Today, globally, about a third of global GDP is in economies that have some form of carbon price, but the carbon price is much, much lower.
Right, because it's set by politics, not by science, really.
In most cases,
a lot of negotiation to set that price.
A lot of negotiation, and certainly both in terms of the number of geographies covered and the price, we're not where we need to be globally if we want to drive a low carbon transition. But the question that we've asked is, what happens if you incrementally increase? And you are right that even before you get to $40, $50, $60 a ton, we looked at if you looked at $25 a ton.
Yeah.
And you see meaningful moves in industries. Part of that is, and healthcare is a good example, is the impact on a company and then on an industry is a function of two things. One is how exposed is a company, and so so healthcare providers, it's very energy intensive, and a lot of these companies actually are reliant on very fossil-based sources of energy.
Is that because of the geography, or just they want to make sure it's very consistent, reliable energy because they have life-saving equipment? Or what is the issue that?
All of the above, I think, and also for a number of those companies, just reliance on traditional incumbent sources and have yet to invest fully in how can they build resilience against those risks themselves. Now, that's not true of all companies. That goes to the transition readiness.
They haven't decarbonized as a sector.
That's right. That's also an industry where we ask the question, how exposed are you? And then what is the, in economic terms, how elastic is your response function? So if you're a healthcare company, pivoting away from that is going to be a multi-year effort. And in the short term, you don't have an immediate alternative ability to do that.
Right.
If you're a consumer goods company selling product A and product B, and those are fungible, and you can move them very quickly. If the higher carbon product becomes more expensive, you easily replace it for the other one, and as a result, that's going to be you're going to internalize less of that cost. So the industry level impact takes into account both of those things and helps deliver some results that, again, were surprising to some of our investors as well. But that's what helps, ground us in an understanding of what the world might look like as and when we see that type of policy action.
So we talked about some of the industries that have high exposure to carbon pricing, that have work to do to decarbonize their businesses. Who were some of the winners of your analysis?
Well, I'll give you an example. Information technology is a good example because you have the combination of two things. One is relatively low exposure to carbon-intensive activity. And actually, a number of IT companies have taken significant steps to decarbonize their energy use. So when they have energy-intensive activity, like in data centers, they've worked to build reliance on zero carbon sources of energy, principally renewables. But the other element is that the IT sector is well positioned to capture the opportunities. So if there's a carbon price, that also makes zero carbon technology more attractive.
Talk to me about risk. Your firm is famous for their approach to modeling risk. And it seems to me that climate change is the penultimate risk. It is big and scary, but also over the long term, it's kind of slow and predictable with a lot of volatility till you get there. Mm-hmm. You'd think it's the kind of thing you could model well, and yet it seems that many industries have struggled to figure out how to model or price in what climate risks look like. Looks like the market hasn't really corrected companies for not doing that well. How does a firm like BlackRock take a look at that?
So look, it's been a perennially hard thing or a hard nut to crack across the board. And I think that's for a couple of reasons. The first is because there is a time horizon bias. People have traditionally thought about climate change in your slow-moving and long-dated frame. And
grandchildren will be hurt.
Sea level rise and their grandchildren, and they say, that's probably a bad thing, but it's outside of my immediate time horizon. And that creates a kind of behavioral bias to actually undervalue risks that may be present in the market today. That's more about behavior. The other challenge has just been about data, and that frankly the people or the sources of the data that are high fidelity around climate science, and climate modeling, and the people with the data around assets, asset values, have not traditionally been the same people, and they've not come together in a way that has created leveraged models and scalable solutions. So we undertook about 18 months ago, an effort to say we should be able to solve this. We have the types of tools and capabilities to measure risk, but we also don't have the kind of climate science data in-house. So we partnered with an outside firm that is their expertise is in the climate science, the climate modeling, and the downscaling of that data. Yeah. We try to bring their data with our risk and analytics together to try to answer some of these questions and figure out, can we get greater fidelity? A couple of things.
The answer is yes or no.
Well,
how'd you do it?
The answer is yes, but a couple things that were surprising and have led us to change some of our behaviors. The first is that one, climate risk is an investment risk, and it's in the market today. And so if you're not focused on that, you are missing an important risk. But the second point is that this is more of a today risk than investors traditionally appreciate. That while looking forward into the future, you do see escalating risks under different scenarios. What's perhaps most interesting and most impactful about the work that we've done is that the risks that are incumbent in the market today. And then that goes to the third question, which is when you then try to unpack and say, okay, well, we can measure these risks, but to what degree are they priced into the markets? We've, in the asset classes that we were studying, found in all cases that the market's not either the market's not pricing it or the market's not fully understanding or even recognizing these risks. Right. Not entirely surprising, but the magnitudes and the specificity give us tools that we didn't have before and hopefully put us in a position to be smarter about those risks.
So we know there's mispricing going on. Would you go so far as to say there's a climate bubble that's living inside of certain industries? Are we headed towards some big corrective event that's going to be very painful? How do you think about that?
So I think about it less in terms of bubbles, and I think about it more in terms of sort of discontinuities, and that you're not likely to see in a particular asset class a sort of serial overpricing of something that then blows up everywhere, but you're likely to see real discontinuities as the risks become more apparent to the market. So let me give you a specific example of municipal bonds in the United States. Yep. So we looked at the climate risks of individual municipal bonds all across the United States and tried to measure for a particular municipality both the direct physical risk, think hurricanes on the East Coast, or think extreme flooding in the Midwest, wildfires out west, but also the indirect effects of heat. So heat reduces labor productivity. None of us are as productive when it's really hot and we don't have air conditioning.
It's actually the weather condition that kills the most people. It's actually the most dangerous weather condition. We talk about hurricanes, they're dramatic, but sometimes the mundane is actually the dangerous.
Exactly, and either it poses physical safety issues and it kills people, or it forces people to spend a lot more on air conditioning.
Right.
And in either case, it becomes an economic drag. So capturing all that together and measuring the relative risks of different municipalities. And then to answer the question of, is this priced into the market? We did a bunch of like-for-like comparisons and said, okay, 2 bonds, 2 municipalities, they have similar attributes.
Give me name names. Give me some 2 cities that went after, or 2 states
Well, so
that went after each other.
we did
horse race.
We did hundreds of thousands of these, but the one that is both the most memorable and cutest is we looked at Jupiter, Florida. So Jupiter, Florida is eastern coast of coastal Florida, and Neptune, New Jersey. Neptune
Nicely done. I like you did there. Nicely done.
Is just off Asbury Park in New Jersey.
Yep.
It turns out, because of the topography, that Jupiter, Florida is very exposed to climate risk. Neptune, New Jersey, not so much. And
So there are lots of parts of that coast are very high risk in New Jersey.
There are, but Neptune happens to not be one of them.
Fair enough.
And so we look at those 2 bonds and we say, well, if this risk was being priced, then you would see that reflected in differential pricing.
And these are similar types of towns.
Similar, so
size of economy and
exactly
everything else is the
type
same.
of issuance, all of that. And so we look at that and we say, can we see differences? And we did that on, we run thousands of models to try to understand that. In this is a cute example. But what we see on the whole is you don't see any meaningful pricing differential.
Right.
And that's not entirely surprising because the data is not readily available. But on the other hand, to us, it signals that there's something missing. But to go to your question of the bubble, I think what is likely to happen is, as we incorporate this into our credit risk model, we now have those issuers coming to BlackRock and saying, are you really using this data? What does it say? Wait, we want to dispute that because we think we've taken more actions to mitigate these risks than you might be aware of.
They've moved their town.
And
they moved it to Neptune.
And that starts to sort of drive change. But as this becomes more apparent, I think what you're likely to see is not a kind of a bubble in the municipal bond market, but instead certain areas where it becomes much more difficult, or where the bar is raised in terms of, if you happen to be in a climate exposed place and you can't move your town to Neptune, then how are you investing the proceeds of a municipal bond in a way that will make your critical facilities more resilient, for example, to those climate risks?
So I guess what I'm asking you is, maybe bubble is the wrong word, is there a domino effect? I mean, as soon as one city, if the mispricing goes on long enough, and then eventually one city is the first to fail, or the first to not be able to raise money and issue bonds, does that create a big pricing correction across many locations? And I understand it's not like the housing bubble, which was everywhere. It will be unevenly distributed, but that could have a massive disruptive effect if there's a cliff and the next day everyone wakes up to just how much risk these cities might have.
We see some of that in the wake of these extreme weather events that are becoming more frequent and more severe. Right? We know that that if we flip from municipal bonds to real estate, residential, commercial real estate, we know that some of these areas are much more exposed. Right? And that manifests itself most intensely when we see these extreme events happen, and you see entire areas that are washed out. Also,
the real estate in the highest demand.
That's right.
So developers and owners and REITs don't want to miss out on the coasts.
Well, and that's where I think the ultimate question of impact, there's the question of market pricing, but then the ultimate question of impact is actually at the intersection of markets and public policy. Because at the end of the day, if you think about something like real estate, the end outcome of what will happen is not only a function of how the market prices it, but also what the public policy response is. And so we're seeing, and this is, when I wore my old hat working in the government at the Office of Management and Budget, we spent a lot of time worrying about the actual underlying lurking liability to the federal balance sheet of these extreme weather events.
It's huge. I mean, we're not going to, are we going to not defend Miami? Are we not going to defend New York? I mean, we probably will, and those price tags will be in the hundreds of billions.
And even more concretely, most of our military installations in the United States face some risk associated with increased severity of weather events. And also, from a policy perspective, you can never have this conversation without also recognizing that the areas that are the most exposed are also, in most cases, the least resourced. And the people, at the end of the day, this is all there is a person, almost always at the end of this. And the people that are most likely to be put in a negative economic situation are the people who have the least means. So people think about, South Beach and Manhattan, but
the risks. They're going to be just fine. They're going to have money to build walls up to the sky.
I think that there's lurking cost that will end up either on the state or federal balance sheet, but the economic incentive to rebuild or to harden is really quite significant. So it's not in any way to suggest that there won't be costs and there won't be market impacts and there won't be individual impacts. Right. But in a place like the Bayou in Louisiana, or in coastal Alaska, where I've spent time, there are places in the U.S. where these risks are profound, and where there isn't a structure right now to effectively deal with the fact that we're creating climate refugees inside the United States.
Talk about urban defense and how big an industry that might become. There's some estimates that to defend coastal cities in America against sea level rise could be a $500 billion, the number was $400 billion enterprise. On the one hand, that is a shocking price tag that some combination of taxpayers and issuing bonds will have to fund. On the other hand, there's a giant industry perhaps waiting to rise to help cities defend themselves. How do you guys view that?
Well, in policy terms, that often gets termed as adaptation. Which
I know, but I'm changing.
Sounds a little kinder and gentler, but really what it is.
I'm changing it to urban defense.
What it is about defending and protecting people's ability to live, right? And that's really what it is. So one, it's big, and it's going to get bigger, and that's true in the United States. But this is going to be a global issue as well. 80% of the world's population lives within 5 miles of the sea globally, and most of the most exposed population centers are actually outside the United States. We also know that because of the greenhouse gases and the temperature increases that have already happened, even if the world were to today stop emitting greenhouse gases, which is not going to happen.
It's not happening right now.
Even if that were to happen, there's going to be a big urban defense and global defense bill, even before we start to factor in the additional warming.
Yesterday's carbon is tomorrow's sea level rise, so it's already baked in.
It also creates an enormous opportunity for how do we make those investments smarter, and how do we build back in more resilient ways? And so, one of the things I worked on when I was in the government in the wake of Hurricane Sandy was we ran a national competition called Rebuild by Design to try to say, let's take advantage of this opportunity where we have resources that was from the federal balance sheet to invest in building back more resilient, but to think and imagine ways of doing this much smarter at scale with efficient building materials and in more durable ways that also encourage more sustainable communities, and don't just build back the way that we've done before. And so I think that creates, that's going to create a lot of opportunity. That's going to create a lot of markets. There's going to be a lot of infrastructure. I think, the opportunity for climate resilient infrastructure globally is quite significant. At BlackRock, we're working on strategies to try to define an entire category of climate infrastructure in emerging markets as an investable asset class.
Why emerging? Why not right here?
Well, we're already one of the world's largest investors in renewable power and renewable power infrastructure in developed markets. Yep. We're expanding that capability. That's a market that is already pretty mature.
This is more like construction and defending a city. It's a little bit different maybe than power generation.
Yeah, but and in developed markets, part of our strategy there is to build out from the capability of sort of core energy production to the adjacent technologies, both on grid resilience, behind the meter, and also then resilience, sort of physical resilience as well. When we look forward at where the demand and where the need is going to be over the next 15 years, largely that increase is going to be in emerging markets because it's where the population increases are, it's where the climate impacts are going to be. And so we believe that that requires different investment strategies, different capabilities, but there's no reason why we can't get that rate right. And frankly, if you think about solving this problem globally, we need to shift a lot more capital into those types of activities in emerging markets. And we want to try to be on the front end of trying to figure out how we can do that at scale.
So take me to the flip side of that. If you figure it out, that's really good news. Or if you can provide the capital for those to figure it out, very good news. But are you guys pricing in at all the worst case scenarios, climate shocks, or how climate change can create potentially poverty, migration, conflict, disruption, like really market destroying effects? It's not necessarily the medium case, but it's a case. Yep. And how do you think about pricing the tail end of possibilities on climate change?
Yeah. So when we think about these risks, we think about them as transition risks and then these sort of physical risks.
Yeah.
And as I like to say, the transition risks are the risks that we hope for more of. We hope that the transition to a low carbon economy accelerates such that those risks become more acute. On the other side are these risks that we have to understand and we have to play out in terms of scenarios. They're the risks that we hope for less of those risks. Right. I would say there's some elements of those that we're getting quite good at, and there's other elements that we really need to push our own capabilities to get better at going forward. So we do model out what we call a no climate action scenario, which is a sort of RCP8, which is think about sort of unconstrained warming and out to 2050 and 2100, and look at the temperature impacts associated with that, and both the direct and indirect impacts of that. Where we haven't gotten the modeling as sophisticated enough on is to build in what I would think of as third order effects around migration, conflict, water, a major resource competition.
These human tipping points.
Right. And in fact, the best work on that is not in the investment space, but in the national security space. And what work that I used to do or used to be engaged in when I was in the government, where the national security apparatus of the U.S. government spends a lot of time on forward scenario analysis on that front and playing it out. And it's the picture's not pretty. And I often, you view a map of the world and you look at those areas that are traditional sources of migration and conflict in the world, and then you overlay warming. Yeah. And it's almost a sort of exact, it's almost an exact match. In fact, if you look at the world, there is a small top of the top of the world, Canada, Northern Europe.
They're doing great.
That are winners. But even in that context, you have to say, well, if you're in Northern Europe, I mean, look what's happening in Europe today in terms of migration, and imagine that compounded several times over. It's not going to feel like a win.
You're going to have a lot of people knocking at your door.
Yeah, and a lot of conflict and destabilization. That we need to play out those scenarios. We also need to do more to make sure that those scenarios are not the world that we end up in. But as investors, and to really understand this risk, we have to understand the implications of those scenarios as well.
All right, so let's flip the script. There's a lot of doom and gloom the last couple of minutes. We'll end on something positive. Tell me the industries or innovations you're most excited about that are investable opportunities that maybe everyone isn't thinking about, something that is a little surprising to you and based on your work.
Well, first I want to hammer on something that won't be surprising, but bears repeating. Okay. Which is the reduction in the cost of zero carbon energy, particularly take something like solar, over the past decade, is breathtaking and consistently outpaces what we think is possible.
And the battery storage to go with it.
And well, so that's the next step, right? But to underscore that, today in places like Chile and India, you see in auction bids, new solar is outcompeting new coal on a levelized basis, right? And that is something that even when we were back negotiating the Paris Agreement in 2015 was a hope and an aspiration, but by no means a reality. Right. And so the speed of that should give everybody some optimism. The second piece is that the big challenge that has been out there is, well, the intermittency of renewable power creates problems in the grid, and that's going to mean that it's going to be harder to transition.
Right.
But
that's the knock on it. People say it's not practical. It's not a consistent supply of energy.
That's right.
No thanks. It's not as good.
That's right. And what we're seeing is the same cost curve declines in things like wind and solar. The underlying technology is driving innovation in storage. So we're seeing storage at scale. I think we're going to see exciting applications of mobile storage. Because part of what you want to be able to do is load shift within a grid.
Yeah, decentralized totally changes the grid.
Totally changes the grid and shifts you out of a paradigm where you're always going to need a grid that has sort of traditional fossil peakers alongside others. Yep. And the pace of technological change in that front, I think, is actually going to mean that the principal barrier is going to be regulatory. Right. That the technology is actually going to get us to a place where it's going to leapfrog regulation and then put pressure on the regulatory apparatus as well. That's exciting, creates a lot of investment opportunities. Two other quick spaces. In the built environment, meaning how we build our homes, how we build our office buildings, and then how we heat and cool them. The built environment has always been a hard nut for people who are focused on climate change because so much of it is incumbent and so much is built.
So much is built already.
And the retrofitting...
It's a past tense word, right?
That's right. And retrofitting is uncomfortable. You have problems that most people live in structures that they don't own. So, who gets the benefit? All of that. The ability to use capital-light technology, software, data, to significantly reduce the energy use of the built environment, huge investment opportunity, and something that I think is sort of goes with the grain of innovation and the sort of explosion in data utilization that we're seeing in other parts of the economy. And the last one I would say is in sort of sustainable lifestyles and sustainable food. That we're seeing a number of companies. Obviously, a lot of people are focused on the success of Beyond Meat, but there's a broader consumer-oriented movement around trying to understand and align the sustainability orientation of the goods that they're consuming and the food that they're consuming. And I think that we are on. We don't exactly know how that's all going to shake out, but I think that there's momentum behind that trend. Right. And if you look at who the consumers of the future are going to be,
they care about this.
They care about this stuff.
The carbon intense, not just organic, but the carbon intensity of.
Yeah, I think consumers are going to want to know, if there's net zero products or low carbon products of the food source, of what we wear, and that is already creating some investment opportunity, but it creates a lot of economic opportunity on the horizon as well.
Well, great. We'll leave it there on a positive note. I appreciate it. Thank you very much for coming in the corner. I'm grateful.
Happy to do it.
Thank you.